Market volatility may be scary, specifically for new investors. Hi everyone, this is Manas once again for you, and today we are going to discuss about the volatility. So how this volatility can be managed, why you should not be worried about today's volatility. So let's understand what is market volatility. So when you are going for a ride, let's say a roller coaster ride, so it will be like this, abhi maja aayega, right? It cannot be like this. अगर ये ऐसा होता तो मजा नहीं आता. तो initially, if you see the volatility means fluctuations, right? So for the first few months or few days or few years, the market will keep on fluctuating. So we will understand why it happens in short run, but in long term, how it is going to help you. So let's understand why this is happening. So there are a lot of reasons. One may be geopolitical reasons, one may be interest rate scenario, one may be investor sentiments. So this is all news, right, which is keep on coming. There are lots of news which is coming in a daily basis, right? So we cannot react to it, but there are certain investors, those who are investing daily, they are trading daily. So if you are not a trader, then you should not be worried about market volatility. But in the other way, people those who are trading, they have both the options to manage. Even if it is going down, they will short the market, and if it is going up, they will be buying the future options. So point is, are you in that rally? So you need to understand why it happens. So volatility is good for you, so don't worry. So specifically, if you talk about new investors, those who have invested now, or investors those who are just investing and then suddenly market falls, then they are all worried. Instead of worrying about the market losses or market volatility, you should keep on investing if you have money. So nothing to worry. I have seen in my personal experience, people those who are investing and then market falls, they react to the market. They react to the investment strategy, they react to the investment advisor. But why to react? While investing, the advisor or the distributor is not telling you that the returns can be made every month or every quarter. So always there is a plan. If you do not have a long-term horizon, or you do not have a goal, then probably there is no point investing also. So you need to understand how many period you are going to give the money to grow. So if it is short term, then probability of losing money is high. But if it is long term, say more than 5 years, 6 years, then I don't think you should be worried about this short term fluctuations. Let's understand people those are investing for a long term perspective. The power of long term investment, the power of compounding effect, the power of having patience for your money to grow, right? So you need to understand, if you are going for a longer period of time, a lot of volatilities will come, and ups and downs, you will get all the benefits because your money is accumulating in that particular phase, right? So somebody, let's suppose, investing through a mutual fund SIP, systematic investment plan. So he is anyway accumulating every month, or there are plans like every day you can participate in the market. There are a lot of mutual fund companies, those who have schemes where you are allowed to put in every day. So all the fluctuations you are capturing. Now some investors are there, those who are thinking that I'll be waiting till market falls down, but they don't have a clue like what is the percentage, what percentage they are waiting for. Let's say 5%, 10%, 20%, 50%. But trust me, which again I'll share from my experience, that I have seen people waiting for a long period and they are not able to get into the market or investing into the market because they are waiting for the corrections. So corrections happens. I'll tell you an example. Let's suppose market is down by 5%. Now you'll be thinking, your mind will tell you, boss, it may go further down of 10%. So you'll again wait for 10%. Maybe if it is market, let's suppose again down by 10%, then you may think of a downfall of next 20% or 15% or another 5%. So you'll be keep on waiting, and you will be trying, you are actually, what you are doing is, you are timing the market, which is not the actual strategy to invest. So timing the market and time in the market is two different things. So if one investor is planning and timing the market is not successful as per the data if you talk about history. And some people, those who have already, they are more number of years in the market, they have actually created big wealth. So you need to understand, timing the market is wrong, time in the market is right. So you better be in the market for a long period of time, you will definitely earn money. Now let's understand, apart from these strategies, you need to see where your investments are going. Let's suppose if you're not diversifying your asset classes, then probably you may lose out some percentage of returns in the market, because sometime gold and silver will do better, sometime equity will do better, sometime debt funds also will be doing better. Now the situation is like, we are about to reduce, in India we are about to reduce interest rate. RBI is going to cut the interest rate. If that happens, then your debt funds is going to give you more returns, whereas the coupon rate, let's suppose 7% is the coupon rate, and you are holding for next 5 years, papers, then even if 1% is going down, then probably 3 to 4% M2M benefit you will get in next 2 years. So you have to diversify in the asset classes. You have to have some investment in gold, that means commodities, some investment in debt, some investment in arbitrage, some investments into equity. Within equity, again, the diversifications we always talk about. Whether it is large cap, mid cap or small cap, you have to have some percentage of allocation based on your goals, based on your returns expectations, based on your tenure, time duration. So better you should talk to your advisor who can advise you in a better way what kind of percentage of money you should invest in different asset classes. So diversification is the key. So let's understand what are the types of mutual fund. So first mutual fund which is very famous in everybody's portfolio is equity. So in equity, what do you mean by equity? Equity is like, you are the owner, partial owner of any company. So when you give money to a mutual fund manager, that fund manager is investing in lot of stocks in different businesses. That means indirectly you are becoming the owner of those number of businesses. Say for example, a mutual fund which is investing 100 shares in 100 shares. So all these 100 shares owner is you, the ownership is you. So if those 100 shares profitability is growing, your mutual fund investments will grow, the value of mutual funds will grow. So it is like completely linked with the profitability of the company. So the best benefit is like whether you are investing 100 rupees per month or 1 crore rupees per month, doesn't matter. You can become the owner of the different 100 stocks. That is the beauty of mutual fund investments in share market. Second category, like a lot of people say that mutual fund is risky. But if you talk about debt funds in mutual fund, debt as a category, it is giving you a guaranteed return, because this is consisting of your government securities, government bonds, corporate bonds, commercial papers, state government bonds, central government bonds. So there are a lot of opportunities, a lot of options which is giving you a fixed coupon. Indirectly it is a fixed deposit kind of investments, but this is linked with interest rate. So the risk here is interest rate fluctuations. So if interest rate goes down, you may get more return in debt funds. If interest rate go up, then probably the demand for the bond goes down, hence you get some lower returns. But the coupon is fixed, so your mark to market will be different. So debt fund in nutshell, people is to invest a lot nowadays because of the taxation. Not a famous option, but it is certainly one asset class where you should not ignore to manage your wealth. This will protect you from downfall over a portfolio. If it is in equity, you must have certain percentage of investment in debt fund. Second category, the third category is, let's say, arbitrage. So the arbitrage fund manager always look for options where he is finding some gap between in two different market. Let's suppose in NSE one stock is trading at 100, the same stock is trading at 110 in BSE, let's say. So he can buy from NSE and sell in BSE, or else buy in current market and sell in the future. Let's say future of, let's say, HDFC Bank is trading at 110, and today the cash value of HDFC Bank is 100. So he can buy now, okay, and sell 1 month contract. So he'll be waiting for 1 month to get that 10% gap. That is fixed return. So arbitrage is an asset class which is giving you fixed return. So today if you see, the returns are somewhere around 7.5 to 8.5 kind of opportunities are there. So now let's understand what are the factors to see before selecting your mutual fund, okay, which is going to help you. So first thing, people used to say the past history, what kind of returns they have generated over a period of time. Let's say 5 years, 10 years, 15 years, 20 years kind of record. They are interested to see, the fund manager, how they have performed in different market. Second, people used to see and talk about expense ratio. What kind of expenses are there in the particular fund? The new fund which is on a higher side, the expenses is on a higher side. But if the fund is big, the large chunk of money is there in the fund, then your expenses is at a lower side. The third thing is like fund manager's experience. If a new fund manager is managing, then a lot of research analysts and advisors do not have confidence or do not advise. But then there are some fund managers, those who do extremely well. So we need to see who is that fund manager, what is his background, his experience into money management. So these are the 3-4 pointers while selecting mutual funds. And second, the most important thing is if you see sectoral rotations, thematic investments, or any kind of mutual fund which is you don't want to review regularly. So then flexi cap or multi cap kind of category, where you can go ahead and invest on an average 14, 15 to 18% kind of returns you can get next 20-30 years. Now in the journey of investing journey, if you talk about discipline and patience, so that is the most important thing in your investment journey, while you create wealth over a period of time. So when it's a journey, then you have to have patience. I mean, more patience than the trading activities. So I'm talking about, it's a wealth creation is a journey of a number of years. It's not one day, 1 year. It's more than 10 years, 20 years, 30 years kind of journey, right? So those who have patience, and obviously that patience cannot come over a very short period of time. Obviously, if you are with a good advisor, those who have, the advisor is having also patience and the advisor is also having good experience, then only he can handle you in times where you are becoming emotional with your money, and he is not emotional because his money is the money manager, right? So he will manage you, your emotions, that means your behavior. So hence in this Jugalbandi you will create a empire of wealth for your own future and as well as for your next generations. So for long term, even if you are putting very, very small amount for your own future, you can create a big wealth. As I said, 10,000 rupees only to create 3 crore rupees over a period of 20 years. So I think India is a new generation. I mean, the young country. So hence you have 20 years definitely for creating your own wealth. So remember guys, investing is a marathon, and that too long-term investment is definitely a marathon, not a sprint. So stay calm, stay invested, stay disciplined to create your big wealth for your family and your next generations.